What we see in Canada is basins with multi-decades worth of inventory. Think of the oil sands, decades and decades worth. We have companies literally with 40 to 50 years of stay-flat inventory where the quality of wells, the quality of the reservoir remains the same. We have other basins such as the Montney and the Duvernay, whose economics are actually superior to the Permian in large cases. In Canada, what we see is an increase in takeaway capacity, meaning we're building out export capacity both for oil and for natural gas. A reason why investors have avoided Canada for a long time is we had inadequate pipeline capacity. And so the United States, for an example, really had the leverage in that situation, and we had the discount for Canadian oil be as wide as $40 per barrel. Because of the build out of excess capacity now, that's shrunk to about 11. So it's wildly profitable for these businesses. For natural gas, we're a little bit behind the curve of our American friends, but finally this year what we have is the build out of liquefied natural gas LNG capacity, which again should be shrinking the discount for Canadian gas relative to the US. So as we move forward in the years to come, as the twilight of shale becomes more obvious, as the call on incremental production growth becomes much more obvious, who is going to be the supplier of choice? Canada's influence in the energy market is going to be meaningfully rising. And so the strategic value of Canadian assets is rising. And in many cases, what we can get are companies with decades worth of inventory, trading at free cash flow yields of between 10 to 15%, that are using all of that free cash flow to buy back their shares. And in some cases, we're literally, because of the nature of theoretical privatization, by buying back their shares so aggressively, we are in many cases getting decades worth of inventory, therefore decades worth of free cash flow, therefore decades worth of dividends for absolutely nothing today.